Welcome to the Broken Pie Chart Podcast, episode 357. I'm your host, Eric Moore. With me is Shane Skinner. Mike Snyder is off today, so we'll assume that any of his opinions he would have given today probably would be all wrong. I'm kidding. They would certainly be good, but he is off for the holiday. All right, Shane, we're going to get into it real quick. Gold, silver, platinum have beaten the S&P 500 and the NASDAQ handily since October 12th of 22. I don't know why Isabel.net on Twitter used that date, but that's what they used. Gold is up 171%, silver 301, platinum 183, NASDAQ 132, and S&P 103%. And like silver, look, I don't know where silver is going to end, whether it's going to go up, continue to go up, continue to, kind of, but if you're looking at that chart, again, I don't know when the end is, but it's like, would it surprise me if it keeps going? No. Would it surprise me if you have one of these where it tops here and then you see a cascade back down? That wouldn't surprise me either. So like this reminds me of the late 80s, early 90s when people were like, oh, you need to have, your commodities, your metals. I think I remember there were like metal commodity mutual funds back then. So like this stuff is running.
Do you think it has something to do with like the pricing in of more rate cuts or a potential weaker dollar? I know we've talked a ton about the central banks accumulating gold, I believe, at least on their balance sheets as of the past.
But they're not accumulating platinum and silver.
Yeah, not right. This is a broad like metals, just metals wide move that we're seeing higher here. And
Shane, you're not wrong though. So if the thesis, remember, it doesn't matter the reason, it just matters that you get flows to these assets.
More buyers than sellers, right?
More buyers than sellers. So if the common prevailing thought, Shane, to your point, is that maybe a weaker dollar, maybe interest rates going up because of the tariffs or inflation or debt. And by the way, we've been in debt. I thought debt was a problem in the 80s. Apparently not. So yeah, if this is causing flows to come into these, yeah, these are in motion now. Like look at the chart of silver. It's ludicrous.
I also think you can make the argument that where we're at right now, right, like industrial metals, there's a lot of structural demand for like electrification, data center build outs, right, energy transition investments. That's sort of, it seems like where all the money is getting spent. The CapEx is going to, right, tech, data center build outs, things of that nature. And so maybe it's also just as simple as, hey, those things are in greater demand now than they were historically or normally over the past maybe 1 to 2 decades. And so with that naturally comes the value and price of those things going higher. When they're commodities, they really behave heavily with respect to supply and demand.
By the way, when I say silver's chart is ludicrous, I'm not saying you should short it. I'm just saying like you have multiple days where it's gapped up. And if you look at the chart, just pull up SLV, like that's an ETF that tracks silver. But Shane, skip all the way down to the bottom of the Word doc. This is from All Star Charts, and they're showing copper miners have broken out. And they didn't go anywhere really since, it's tough to see on the scale, but probably 21 through the latter half of this year. They went sideways. Gold miners. They kind of based in a saucer pattern. They broke out. Steel stocks breaking out. Aluminum, and they have a question mark on their chart because you have this saucer, this long basing pattern, this saucer. And the question is, do those break out? Like, I think that's what you're getting to, Shane. Like it's all these metals all of a sudden people are really going after.
Right. And miners naturally benefit from an increase in the value of the thing they're mining, I would assume. I'm also wondering if it's almost like this perfect combination of financial sort of like environment, if you will, interest rates coming down. I don't know the debt to equity ratio, what the historical like average is for mining companies. I would assume they're fairly leveraged in debt though. Again,
I don't
that's
know that. I don't.
I don't know though, and
Yeah.
I shouldn't say that that is because I could be very wrong. But um,
Look, I mean, the
it
thing with
just
miners, though, wouldn't you agree, Shane, that if you buy a miner, you're also buying the management, you're buying their enterprise value, you're buying their debt stack. Like the metal could go up or down, but the company might go down or up inverse to it. But I obviously, if they're selling, if they're mining gold and gold is going up, yeah, the stuff they're selling is worth more. They're getting more
yeah,
for it.
there's a correlation, and I absolutely I think that it varies. Um, the level of correlation maybe at times, but um, again, broader environment just we find ourselves in currently might be one that they're almost double dipping, right? If looser policy combined with the increase in what they're mining, the underlying value of metals, right? It just seems like a perfect environment for those
But
right
let me give you a crazy stat. It's not even a stat. So DBC, here's a like a broad based commodity. It's very oil centric. So we'll talk about oil, but look at a chart of DBC, and I pull up like a maximum chart, whatever. It's today. It's 2268. It was. Let me see where it was in. In like 2008. It was the same price. Like if you bought it in 2008, you basically flat. I don't think it pays dividends. Again, this is very like the weighting in this. It's weighted more towards oil, and obviously oil is not, especially in inflation adjusted. But it's you have these cycles where commodities really run, but it hasn't been all commodities. Like oil is it's going nowhere. I mean, Shane, you pulled up some research on the gold versus oil ratio. Isn't that like an all time low?
Yeah, it's pretty incredible, and I know we talked about earlier in the year how like the performance of oil versus gold this year alone is like I don't think it's ever moved the way it's moved as significantly as it has this year prior to now, at least for the past 50 plus years. Now, in terms
I mean,
of the
you've got a
oil,
chart. This is from the World Bank, going back to 1960, right?
yep, yep,
It's
and it,
lower than it was in. It looks like the late 70s,
yep,
and the only lower point on this, it looks like 2020, April of 2020.
which I remember I was, fresh on, getting into the market at that point and oil went negative and my mind was blown. I didn't realize oil futures could do that. And yeah, no, it's
I mean,
pretty
it took negative oil to actually have it be lower than it is right now. So, what is the significance of this? Like, what do people do? People who look at this ratio, like, why are they looking at this? Why is this important to them?
I think it gives us an idea like oil affects everything, right? The price of oil, would you argue, is a huge driver in inflation.
Yeah, it's a big input in everything.
It's a
Sure.
huge input, right? I mean, as we just talked about how the DBC commodity index, right? Other commodities are running and yet oil isn't, and therefore it looks like this index really hasn't done a whole lot this year. It's moved, but with oil staying down, it's. I think maybe there's your case for why inflation hasn't been nearly as rampant as people expected it to be for the year. I also think that there's this list I sent right of these different things that happened since like the 70s to now. And I think it's important for people to remember that like often history rhymes, but it doesn't necessarily always repeat itself.
Mark Twain.
Yep. Oil crisis in 1970s and 80s. You told me, watch Argo, right? I mean, you had the Arab oil embargo and the Iranian revolution take place during those periods. There's a significant geopolitical event, right, that affects the overall price of oil. You get the price slump in the 80s and 90s. Um, that supported the ratio. Then you get the commodities boom, right, of the early to mid 2000s peaking we see in about 2008, I believe, 2007, 2008. So, and then it mentions the gold rally. in the late 2000s and early 2000 teens, which is, I think, the last time we've really seen metals run the way they're doing now. And then, of course, it's just sort of been this weird sort of, everything's been fairly tame minus COVID in 2020. But it's just interesting because someone like myself, again, I mention it all the time. My generation's newer to the markets. We've only been in it for the past 5-10 years. And so I can't remember the last time metals were this prevalent, or, really sort of the thing. I shouldn't say.
I remember the mutual funds and stuff. So, by the way, it's Arab oil embargo. I know you're reading off the thing, but just to give.
I apologize.
Yeah,
Sorry.
yeah. So I did look at DBC, and I wonder if they've done because I'm based upon Bloomberg, crude oil, West Texas Intermediate, Brent, 11.6. Yeah, it looks like I have to look. I wonder if they've reduced their crude oil, because I feel like that used to be a little more. All right, we'll have to research that. By the way, if you wanted to, like, the contrarian trade for 26, and I'll let you know if this works out. It's you buy like what, the XLE, the energy sector ETF.
Yeah, buy energy. Yeah, and maybe sell a little gold. That might be the
a pairs trade. You want to short gold and buy energy, or are you saying reduce if you have gold, reduce it and go to energy?
More reduce it, but yeah, I don't know if I'd short gold here, but at the same time, it's interesting seeing this ratio behave this way over the past 60 years, seeing where it's at now. You would think that ratio would revert, but who knows? We're in a really, really interesting time.
Yeah, we'll see. We'll see what happens there. All right, let's move on. Let me do a quick hit.
Back.
Shane.
Sorry, I lost connection.
And
it's an interesting time we're in right now, to say the least.
You kind of broke up there for a second, but let's switch to a quick hit. Jeff Weiniger had put something out on Twitter. S&P US 10-year Treasury inflation protected securities tips total return index. And he has this chart, and he said investors who bought tips in the circled periods, and I'll explain what that is. If you bought like June of 2020, December of 2020, kind of before we had inflation, you're still down money. And he says, here's your periodic reminder that Treasury inflation protected securities tips did not protect anyone from inflation. People who bought them in 2021 haven't made a dime. It's time for a new name for tips, and time for people in my industry to open their mouths and say so. And this is quote unquote from Jeff on Twitter. All right, here's the thing. This is an index. I don't know the maturity and therefore the duration of the index, but here's like the public service announcement. Like if you're buying tips bonds with longer maturities and hence more interest rate risk, if interest rates go up, bond prices go down. You still have duration risk, meaning interest rate risk in tips. And then the other thing is you think about where we were coming from. Tips bonds, some of them had negative yield to maturity. I remember coming into 21. So when you have something with rates that low, the interest rate sensitivity is much higher. So I thought it was an interesting chart. All right, another quick hit, Shane. This is from Isabel Net, and it's a chart of truck tonnage index versus the S&P 500. And I believe that the truck tonnage index is the Bureau of Transportation Statistics, BTS, calculation from the American Truck Tonnage Report. All right, I'm going to have to look for that because I do watch the shipping containers. Shane, what this basically is saying is as truck tonnage increases, so does the market. But wait a second. If you see these two lines, they sort of traced each other, one on top of another, meaning if they're both going up, one's going up, they're both going up. And then it really decouples in kind of the end of 2019. Truck tonnage has gone sideways while the market's gone higher. So I haven't done, I do look at some of this stuff. And by the way, the R squared on this since 02 is like 0.72. So a high correlation here, a high R square. But imagine you're like, oh, I'm going to short stocks because the truck tonnage index is flat and it's got to, stocks have to come back. So I don't really have too much on this, Shane. I think it's interesting.
I do too. Maybe you could make the argument looking at this that prior to 2019, 2020, a lot of the market's performance or growth or what was going on was based on
Oh, goods. You're going to go with,
goods.
the
Yeah,
argument for
goods,
goods.
right?
Sure.
And now I'm going to go with the argument that now,
It's
with
services.
recent services, and look, with that recent GDP print, I really think that we're seeing this isn't like a classical demand boom going on in the economy right now. It's a productivity driven expansion with massive investments being put into AI and these data center build outs. And so with that, I think we're going to continue to see more of these weird decouplings, if you will, decouplings. I don't know if I said
Decouplings.
that.
There you go.
Decouplings. See, I just I need to go back to
It's
grammar school.
the day after Christmas.
Okay,
Yeah.
thank you. But no, where I'm going with that is that I wonder if we're going to continue to see norms of the past decade or two, three, four, um, become less normal, and that doesn't necessarily mean it's good or bad. It just times change, things change, economies change, markets change, in some aspects, and so I wonder if again we're starting to see the decoupling of the sort of the
No,
old
it's
economy.
possible. I mean, we see that in net profit margins. I mean,
Exactly
I wouldn't be surprised if at some point the forward earnings net profit margin forecast reaches like 15 or 16%. And, that's another one where people said there's no way margins can remain this high. I was going to do this later, but, one of the reasons why, and I think it goes to your point, we've gotten much more of a services economy, infotech, these types of things. Sam Rowe had put something out in his newsletter, TKER, and he highlighted a chart from Bank of America. And their exhibit was incumbents are getting disrupted even more quickly. Average company lifespan on the S&P 500 index from 1965 to 2030, and in years, rolling 7-year average. and I'll put a quote from B of A in here that he dropped in. The growing impact of disruptive companies can have downstream effects on incumbent companies. Roughly a third of the S&P 500 has been replaced since 2015. In 1958, the average 7-year rolling lifespan of a company on the S&P 500 was 61 years. By the 1990s, it had dropped to 30. By 2016, it was 24. And by 2021, it was 16 years. If we continue on this road, by 2027, companies could last just 12 years as they become increasingly disrupted. I mean, there it is. Like you see, and I watch this stuff, but who's getting removed from the S&P, who's coming in, and that's why the S&P 500 in itself is a momentum index. Like you're
right.
getting stuff that is graduating to that. You're taking out other things.
Well, and that's
But
why index investing's become so popular, wouldn't you say? Because it's really hard to know who's going to replace who and what aspect and what factor. And by staying in the index, you keep yourself exposed to both sides of it.
yeah, I mean it's interesting because you look at, and I would agree. I mean we're big fans of well diversified broad index like the S&P 500. You don't have to pick the winners and losers. Let the index do its job. It's pretty efficient. What we are seeing, let's say, if you bought commodities have not, theirs were a little more of a quote unquote stock picker's advantage would be, if you had gold, silver, and some of the metals, oil obviously hasn't done much, but commodities has been relatively flat, like we talked about for a while. So, but yeah, indexes, and it just goes to your point, like as these industries change and companies change, that's reflected in the index. So,
What
Ed
did you
Yardini.
go ahead?
So Ed Yardini put out something. I guess this is from Isabel.net, but they're highlighting Ed Yardini's research. So what does he have? This says, quote, gold could glitter brighter in the years ahead, with your Denny research projecting a run to 6,000 by 26 and 10,000 by 2030 on the back of deep fiscal deficits, money printing excess, and mounting global tensions. All right. By the way, like I said, this could have been an 80s prediction too. I mean, it could have been 90s. Like we've had deficits for a while. We printed money for a while. And there always seems like there's global tensions. But I mean, yeah, imagine what are we at today? 40. What is gold today? I'm looking at not GLD, but I'm looking at the commodity index. Hang on, I'll pull it up here. Yeah, 45.25. So he's saying 6,000 by 20. Or could run to 6,000 by 26 and 10,000. So I mean, if it goes to 10,000, that's more than a double by the end of this decade.
It's
sure it could happen, right?
It
Sure,
could happen. Yeah, no, it could happen. I also just this is
you know what's going to happen though, Shane.
This is a channel. This is a channel on this chart. The technical analysis here.
It's you also have another channel from 2020 to
thank you
23 that it was a sideways channel. Sure,
that's what I was going to say. So that's the thing. I mean, how long this breakout continues to run, who knows? You know, this is a pretty it's pretty tilted angle here. You know, it's not quite going straight up, but you know, the implications of gold moving this much higher to me, I don't know.
I mean, its history says it moves. So gold typically moves a lot and then it goes nowhere for years.
Exactly. So if momentum dies, if everybody stops, you know, it doesn't matter like what you said earlier in the podcast. It's all based on what people choose to do with their money, right? And it's sort of, it can be narrative driven.
If we got to the point, Shane, where people who never really invest in markets are asking you, "Oh, should I buy gold?" That happened in 2008 with oil.
I mean,
to me,
my wife came in about a month or two ago and was like, "Hey, should we be looking at gold?" And that's
all right. So maybe it is that.
That's what I said. I said though when she did that, I said, "All right, pack it up." You know, no disrespect to my wife, but she does not pay attention to markets too much, and so there is that concern that like once people who normally don't pay attention or participate start asking about certain things, maybe it's time to not be in that thing. But I mean, again, this is all based on, I think, a theory or a narrative or a belief that, you know, the broader global financial system and the U.S. financial system are going to force people to have to put their money into other assets so they don't get inflated away. I don't know how inflation can stay within Fed expectations and simultaneously.
No, but people do that. They put it in stocks. Stocks that beat inflation.
Absolutely. And what happens, you know, gold's been better than the index so far this year. As we head into the final week, that begs the question, you know, for after 1 year of gold no longer outperforming the index, you know, do people stop and take their money out of gold and put it back into the index? I don't know, but who knows? This could be short lived, and we only get a couple more years to maybe a couple more months of this running. This could be a longer.
Can I tell you, Shane? 2008. I'm looking at July 2008 oil, West Texas Intermediate. Just looking at the continuous commodity, you know, the near contract, but it kind of strings it together. So the oil price was about 145, and today it's 56. So, and I remember a friend of mine who has never traded commodities before sends me a text and says, "Hey, if I wanted to buy oil commodities, how would I do it?" And I was like, you shouldn't do this. Like that to me. And it was right around that 145. So
yeah, you got to be careful with commodities, you know. These
Well,
are
yeah, of
these are
course, with commodities, because you have a lot of leverage in there. But
exactly.
I mean, nowadays, there's like if you were trying to express a view on oil, you could probably buy some of the oil companies. And then it's the same argument we would say the price of oil could go up and these companies might not be operating efficiently. I'm not an analyst on the companies, but all right, we'll see what happens. We're going to do our prediction show next week. So we'll save some of this stuff for then. Let me go to, um, do we talk about earnings growth versus multiple
We haven't.
growth?
No, we have not.
All right. So JP Morgan's their guide to the markets. They had something that was out, and the title of their graph was Increasingly Profits Are Driving Returns in This Bull Market. Contributions to Annual S&P 500 Price Returns. And in 23, 27% of the gain in the market that year was earnings growth. 73% was the multiple growth. So in other words, like if you go from 20 times forward earnings to 21 times forward earnings, that would be multiple growth. If you stay at 20, but all your gains are based upon the forward earnings estimates going higher, well, that would be earnings growth. So 24, 55% came from earnings growth. But 2025 year to date, almost 80% has come from earnings growth compared to, around 20% coming from multiple expansion. So this year has not seen multiple expansion, let's say. It has seen earnings growth or earnings expectations growth. And, that is, let's save it for next week, Shane, because we're going to talk our forward predictions. But like this is, a lot of the talk is going to be on valuation, and a lot of the talk is going to be, what if we go back down to a historical norm and forward PE ratio? But, and I think I mentioned this before, Sam Rowe has pointed out in the past through his TKER newsletter that the analysts, barring recession, are pretty darn good at kind of projecting what earnings are going to be. So anyway, I thought that was interesting. The other thing I wanted to bring up, Shane, was nearly all major equity markets have outperformed the U.S. in 2025 in local and in U.S. dollar terms, meaning their local currency, and then adjusting for, local currency and U.S. dollar, accounting for currency, what do you call it? Conversion. There you go. So, and you look at these, and so the IBEX, I think that's Spain, right? The KOSPI, MIB, the DAX, that's Germany, the Stocks 300, that's a European one, the FTSE 100, MSCI China, MSCI EM, MSCI Asia Pacific ex Japan, like all of these have outperformed the S&P 500 this year. I don't know anyone besides the people who always say it's time for international to have a run. I don't know anyone who had, like, oh yeah, all these international ones, they're going to cream the S&P 500. Like, I don't think people really had that on their bingo card.
No.
And by the way, the IBEX is Spain's IBEX 35. So 35 company. It's up over 70% this year to date.
No, I think that there's a lot more access to a lot more markets now than there ever has been. I think that's
all right. I disagree there.
No.
I mean, you've had, how long has the iShares Spain been available as an ETF? I think it's still out there. Like you could get these markets. You could buy EEM. You could buy EFA. Here, I'm going to look at iShares Spain ETF. Let me see if that's, EWP. Look at a chart of EWP, Shane.
Back since I was born, 1990s.
EW.
90s. Yeah, 1996, 97.
Yeah, like look at this chart this year. Up and to the right.
Interestingly enough, too, we haven't seen a run in this chart this up and to the right. So with this velocity, I'd argue since probably 2006, 2007. Maybe you could argue a couple times in the early 20 teens It had some aggressive run-ups before turning back over, but we're at a pretty critical level. And what do you think? Does it? I mean, do you think that this type of performance in names like gold, foreign markets, the S&P's been up this year, the Nasdaq's been up, not nearly as much as these other areas of the market that you could invest in. I mean, is that an indication or a sign that?
I mean, they've been underperforming for so long, but look at what's in, the IBEX 35. I just pulled it up. Banco Santander. I don't know. It looks like they have some banks. Let me see if they have a.
The EWP has had a positive month every month for the entire year of 2025.
44% financials, 21% utilities, 13.5% industrials, 9% consumer discretionary. Where's the tech? Tech isn't even like communications, 5.5%. And what do people say? Oh, it's 7 stocks who keep the whole market up. Like we're looking at the. I mean, I haven't looked at this in a long time, and I just looked at it because I saw the chart from who is that chart? I got to give them credit there. I'll find it. But
I mean, do you think that
Data Stream, Stocks, and Goldman Sachs, by the way, put out this chart.
you,
But to answer your question, like these have been readily available.
that's fair? That's fair. I also wonder if there's
But they've been widowmakers. Like imagine an advisor, or they're building a portfolio and they're telling people you need to have, I don't know, I'm making this up, like a third international. It has underperformed for years. So people haven't wanted it. And I think it's, unfortunately, it's how investing works with the, a lot of times the stuff that has gone up a lot will get more flows to it. The stuff that's gone down, nobody wants it. But no, I just think it's been a widowmaker for a long time, Shane. I think that's why. And these valuations were much lower, but I mean, did you have Spanish banks on your bingo card? Like, was that? Yeah, I need to own all the Spanish banks.
No, I'm kicking myself for missing that. It was so obvious in hindsight. But it's no, you make a good point, and that's another thing that maybe is worth mentioning is stuff can get like we'll know in a few years whether or not this is something much more broader and structural, or if this is just sort of a one-off year. But I just
look at a chart of EWY. That's the iShares MSCI South Korea ETF. Look at that chart. That's
and it hasn't been this high since 2006, 2007.
Yeah. So let's see what's interesting too is totally different than they have almost 45% in infotech. Wasn't even a top one on the Spain one. Industrials 20%, financials only 11.5. Remember the Spain was 44.5. Consumer discretionary 7.31, healthcare 4.73. Yeah, like these two things, if you look at the sectors, they're very different. Obviously, the countries are very different, but this has been a really good year for markets. And I think it's so lazy when people keep saying, well, it's only a couple stocks. We just looked at Korea and Spain, their ETFs.
It's interesting that you point that out because you make a really, really, really good point. Markets in general have done really well this year. Again, not just U.S., foreign, gold. I mean, the only big asset that I can think of that's really just missed expectations big time on this year for some people has been Bitcoin, down like 6.6% this year. And
how about that? By the way, at the beginning of the year, everyone thought I'm using air quotes here, Shane, but Bitcoin's going to 1 million. Nobody had Korea and Spain. Like it was all Bitcoin. Like, whoops, that didn't work.
Well, yeah, and I mean, you have the hype around the new administration coming in and seeming to be very pro crypto, and doesn't necessarily mean that translates to Bitcoin rising in price. I think we've seen now. But there was a lot of hype around it. There were really high expectations. A lot of the big shot callers, calling for what 150, 200,000 within the next year
Okay,
or so.
right. Not a million.
No.
You're more sanguine in your
But
your analysis of it. Sure.
but I mean, I've been told by both sides. I've had people on my right screaming about how gold's pointless. Why would you own it? You gotta own Bitcoin. It's the feel. I've had people on the left, me saying, why would you own Bitcoin? It's not real. Own physical gold or own, paper, but just own it. And it's crazy because one year, one side's right, it seems like. So I just,
Who
I know
knew,
that one's
right?
been a really
Gold,
interesting one.
Spain and Korea. Like if you would add like 33% in each, that would have been a heck of a portfolio
Right.
in
No, and
hindsight.
no one told me Spain or Korea.
Yeah.
But
Hey, I got an idea. Put a third of your money in Spain, a third in Korea, and a third in gold.
someone probably did that and got laughed out of a conference, but they're laughing now. So good for them.
Well, let me look at this too. MicroStrategy. So I did a chart in Bloomberg, and it's called the spread chart. And what it does, it says, well, if you bought IBIT, which is the that's BlackRock's Bitcoin ETF, and you sold MicroStrategies, it's just a way to sort of see the differential or the relative performance. I'm not saying that was the short, although in hindsight, I mean that was the Jim Chanos trade. So when I look at this, Shane, I went back a year and I wanted to see the underperformance or overperformance of IBIT, which is just basically holding spot Bitcoin, versus MicroStrategies. In May, holding Bitcoin or IBIT they did 15.38 percentage points worse than holding MicroStrategies. And then it sort of flipped. And since the July high, I mean, it's really ran the other way. So currently, IBIT is down 8.91% year to date when I did this chart earlier today, and MicroStrategy is minus 53.7. So that's the delta or the difference there, and the number of percentage points is 44.78. So just going back 1 year, this was the Jim Chanos trade, Shane, where he shorted MicroStrategies and he bought Bitcoin, right? I mean, this is I think he put that on in June or July. I don't remember.
Seems pretty well timed.
Yeah, good for him, man.
No, and it's interesting because you get into like the nitty gritty of how the microstructure or MicroStrategy thing works, and I mean I think we were in agreement that the only thing left here to do is probably issue more equity, and I'm not saying the market did or didn't know before MicroStrategy had its incredible run up. But it's almost like the market's kind of gotten wise to it, or at least enough people have started to no longer believe in it that, we're starting to see this. You made a really interesting point, though, prior to us jumping on this, like if it sells off so much to the point where it's trading almost at a discount to the amount of Bitcoin it holds, does it catch at that point? Maybe, but again, you're buying just back into something that's just issuing debt to.
I also just want to point out, like, you don't have to. I say the audience, like, you don't even have to be concerned about this. I mean, this is why you stick with index funds. We like to buy and hedge. We think that's a good way of doing things. Take away some of the downside risks. Certainly, we use broad indexes like the S&P 500. But like, to me, like I don't believe I have any interest, a horse in this race.
You're not losing sleep at night over this, are you?
I don't think I have any positions in any of this stuff. Yeah. So it's like, but I watch it and I want to see how this ends. I really do, because I have sort
There
of
will be books
my
written on it.
opinions on it, but
There will
you
be
know,
books written on this. There's gonna, it. It's pretty incredible, just the story of it all. And I mean,
I mean, if it had gone up to 200,000 though, would it be a different story?
I think it would. I do. But again, if your
Would it still
entire
been trading at higher than its intrinsic value of the Bitcoin on its balance sheet?
I don't know if it would be trading higher than its intrinsic value, but I do believe the stock would have like benefited from it by default. But again, though, I could be wrong because if you're really looking at this from a standpoint of if I'm bullish on Bitcoin, why would you buy a stock in a company that's just essentially managing all that for you when you could just buy Bitcoin yourself via the ETFs that are available? So I almost wonder if there was more appeal to it when the ETFs weren't as popular or available. It was almost like a way to get exposure to it without directly buying it on a wallet or um, buying into the ETNs or whatnot that was out
No,
there.
that's a good point. But now an investor, and it's I mentioned IBIT because it's been around for a while. It's one of the bigger ones. I'm not saying that's the best one or the worst one, but like that one pretty much tracks the price of Bitcoin on a relative basis because they own Bitcoin. But that's a good point. Like, yeah, if prior to these being all available, but it's all available now. Like any
Right, right.
Fidelity has a Bitcoin ETF.
It's like that same
BlackRock has
stock.
one.
Yeah, it's like the same stock you brought up last week, or the company that got mentioned because they have a very, very small partial ownership in SpaceX. Well, if everybody's sole purpose of investing in that company was because they have some exposure to SpaceX, if SpaceX becomes available on the secondary market, in my mind, I would think that that would cause
Well,
outflows out
there
of that name and into the actual.
maybe, but it's
But markets are funny like that,
well in
you know.
theory. I think why people are buying that because they think they buy it while it's still private, and then when it goes public, there'll be a premium on the IPO price. But anyway, all right, let's move on from MicroStrategies. Couple other things I just want to mention. This is from Goldman Sachs and FactSet. Russell 2000 annual EPS growth estimates. Consensus 2026 is for Russell 2000 EPS to grow 61%. They grew 217% in 2021 after falling minus 57%, probably in 2020. Yep. You go back to '09, plus 142%. Of course, they had come down quite a bit in '08. So this is the belief that companies who have debt and are probably paying more because they're small cap companies in the financing rate, that they will be disproportionately benefit from a lowering of rates. So yeah, I mean, we'll see. That would be a big jump in earnings. I,
I'm
I don't know.
excited. I'm excited. It's gonna be interesting with the stepping down of Powell that we're anticipating, or I should say, I don't think he's stepping down, but his term ends. Um, yeah, we've like that's pretty monumental thing, and if they're very dovish, um, with the new sort of regime there at the Fed, then we could see small caps benefit significantly. Um,
All right. Last thing, Santa Claus. If Santa should fail to call, bears may come to Broad and Wall. Oh, I like that. This is from is this Ryan Dietrich? It looks like his work. Yeah, on Twitter. So let's go over some of these Santa Claus rallies. So last year was December 24th through January 3rd, and the market was down minus 0.5%. January is up, Q1 was down. Okay, we don't know for the calendar. We know the calendar year is going to be up. So, okay, that was last year. And then you have, let's see, 2023, 12, 22, 23 to 1, 3, 24. So this is like this narrow period, basically the first trading day of the year. And then day, the last trading day before Christmas. So we're in the Santa Claus period now. I don't know. I guess what they're saying is when the Santa Claus rally is negative, January tends to be negative.
I hate seasonality. I don't know if I've ever told you that. I'm not a big believer. I think some year more people end up buying at the end of the year because they want to put money to work and taxes aren't an issue. They don't need to sell. I think some years people choose to do more selling because I don't think there's really a perfect.
Well, you want to root for a Santa Claus rally because according to this data, then, if markets stay in motion, they remain in motion. I don't know.
Yeah, I think the main thing, the one that I
is it the 24th? Is that the? So I don't. You know what I'm not getting here? Why are these dates different? See how it says 12, 27, why is it the 27th?
Because the shift in dates for the calendar that year. I'm wondering, depending
on. Oh, you know what? Yeah. Maybe they gave people off if Christmas was on a Saturday or Sunday. Maybe they gave people off a Friday, so it'd be 24th, 25th, 26th, and 27th was the. But why not the 23rd then? Like, why is it the 24th and the 22nd in some years?
I'm also. It could be some overfitting here. Well, we might need to do this ourselves. Check it out.
No, I think Ryan Dietrich's work is generally pretty good. I have a question on why the dates are different.
I'm sure he's got an answer for it too.
Okay. Oh, here it is. The Santa Claus rally is the final 5 trading days of a calendar year.
There it is.
And the first 2 of the following year. Okay. Sorry, Ryan. Your data is very good. Yeah, I apologize for. So that's what it is. So the final 5 trading days. All right. I guess I should look at this. So final 5 trading days this year, Shane, includes the 31st, 30th, and the 29th, the 26th. Okay, so it'd be the 24th.
Yep.
Okay, makes so sense. What are we up since the 24th? That's the key. I'll tell you right now. I'm going to look at do this on the fly here.
Big GDP number came out this week too. Crushed estimates.
All right, let me see. So 2025, let's see what we're 2025. What was that? What did we say it was? The 24th?
We opened the 24th. Let's see. We closed.
So no, I got it here. So we're down 0.02%.
All right. So let's have a positive week next week. And
then we got the Santa Claus rallies there and we're all good, right?
Yep. All our problems are solved.
Let me go to you, Shane, for any recommendations for the audience.
Yeah, I got to shout out my alma mater, Illinois State Redbirds football. They're going to the FCS National Championship after winning every game on the road so far in that tournament, including upsetting number 1 seed North Dakota State. So that will be a great game in Nashville. There's still some time coming up. I believe that's on Monday, the 5th of January. So got some time for that. I'm also going to shout out, there's my step-grandfather turns 85 this weekend, and we were doing some reminiscing, thinking back on the years, and he showed me probably the greatest comedy of all time, Young Frankenstein, Mel Brooks, Gene Wilder. I think Peter Boyle's in that. It's just one of the best. So,
all right, Young Frankenstein. That's Mel Brooks is a classic, and Gene Wilder. Gene Wilder was in what's the movie with the Charlie and the Chocolate Factory?
Yep. That was was that?
I mean, Gene Wilder's in a lot of stuff. But
yeah, great actor.
All right, I started watching a show called The Pit. It's on HBO Max, and I was frustrated because I'm like, apparently I was watching the TNT version, and it had commercials, and then I realized I could just go to HBO Max and there's no commercials. So pretty good so far. I'm only through like 1.5 episodes, but I'll give it a buy recommendation at this point. So there you go. Nice. All right. Next week we'll be back. We may have a special guest on the program. We'll see if our timing works out. and we'll be doing our prediction show. So definitely one you want to check out. I would say that a week and a half ago, Shane, my S&P 500 year-end prediction would have been pretty much spot on. I think it's a little bit higher than where I was, but we'll get to that next week. So thanks everyone for tuning in. Tune in next week as always. Shane, thanks, and we'll talk to everyone soon.